Hi, in this chapter, we are going to be talking about financial markets and a model of the firm. A firm has owners, the businesses can be of different kinds, but normally a joint stock company would have shareholder as its owners. And the point that I wish to make here is that a company is legally distinct from its owners. As a result, shareholders are not personally liable for any financial obligations of the company they own. For example, if a company owes money to a supplier and is not able to pay the money, then the suppliers cannot sue the shareholders, but they can only sue the company. So, this is what we mean when we say that a company is legally distinct from its owners. So the idea is to understand why companies are set up and why do shareholders want to be distinct from the company and what advantages does a company have as a form of organization. Uh, Companies get money through financial markets. So financial markets connect investors to the companies, and good firms or good companies can access resources through financial markets easily, and bad firms would find it difficult to access resources through financial markets. So, in this sense, financial markets are very effective as tools of rationing capital. So, they help good firms to get money and thus ensure that only the good firms survive in the economy and the economy as a whole remains efficient. Stocks and bonds are instruments used by firms to access resources through financial markets. So, in very simple terms, a stock is a piece of paper that a company gives to an investor and receives money in turn. The investor who gets the stock in turn would get a certain number of rights and obligations. Similarly, a bondholder is one who gives money to the company in exchange for a piece of paper called the bond, and bonds have certain rights and obligations too. So, when we talk about the value of a firm, it's essentially the value of the stocks and the bonds of the firm. Stocks and bonds of a firm are traded in financial markets, but that's not always true. There are firms whose stocks and bonds are not traded on financial markets, and we will discuss about those later. So, market value of stocks and bonds are not static. They move every day, in some cases, even every second, in response to what is going on in the markets. The markets respond to changes in the overall economy or expectations of changes in the overall economy. Markets also change in response to performance of the underlying firm. So the market value of a firm, which is market value of its stocks and bonds, is not static. It changes all the time. But value of a firm is the value of its shares or stocks plus the value of its bonds. So, what does a firm do with the resources that it raises through the financial markets? Well, the firm entrusts its managers to manage these resources. And managers are expected to manage these resources in a way that maximizes the value of the firm, or in other words, the value of the stocks and the value of the bonds. This is the primary advantage of creating joint stock companies, separating owners from the company. So the separation allows owners as investors to entrust specialists such as managers and other technical people to manage the firm in a way that maximizes the value to the investor. Of course, there is a potential for conflict between managers on one hand and the stockholders and bondholders as investors on the other, and this leads to problems of corporate governance. So, in the big picture, investors go through financial markets in order to finance firms, and firms are managed by managers, and these managers have to work in the best interests of the investors, which means maximizing the financial value to those investors. More on these in subsequent lectures.